Assalamualaikum. My name is Syahira binti Saidin and I will start with the introduction of Digi Telecommunication Sdn Bhd. Digi Telecommunication Sdn Bhd is formerly known as Mutiara Telecommunication Sdn Bhd, and the company changed its name to Digi Telecommunication Sdn Bhd in January 1999. Digi Telecommunication Sdn Bhd is a mobile service provider based in Malaysia, and Digi Mobile Communication Company is engaged in the establishment, maintenance and provision of telecommunication and related services. The company was founded on 24 May 1995 and the headquarters is located in Shah Alam, Malaysia. Next is Digi is the first telecommunication industry to launch and operate a fully digital cellular network in Malaysia. Thus, Digi can get more market share in Malaysia to compete with other competitors. And Digi has also provided a variety of mobile communication services including voice under their prepaid plans and postpaid plans, SMS, data plans and services, international roaming, international calling card, WAP services and others. Besides, Digi is the first telecom in Malaysia launch and operates a fully digital GSM 118 MHz services. Additionally, Digi was the only Malaysian telecommunication provider among all Asian countries in 2014, and it was placed 100 among the world's most innovative companies by Forbes, which is an American business magazine. However, according to Channel News Asia, this company was ranked as one of the top 3 in Malaysia and 40 in Asia top 10 sustainability rankings in 2015. Next, we move on to the SWOT analysis of Digi Telecommunication Sdn Bhd. For the first part is we going to look at the strengths. One of the strengths of Digi Telecommunication Sdn Bhd is its well-known innovative approach to the market. The yellow coverage fellow marketing campaign has been so far very successful in its target demographic. Product and services offered by Digi has been quite innovative. Digi Prepaid hit RM1, Friends and Family, Talk Time Transfer, Digi Bonuses, Digi Privilege, Digi Priority Services, and the merger of them were very well received by the market. Second is its low cost leadership strategy has turned Digi into being one of the market leaders in the country and also triggered the price war among the competitors with its low cost strategy. Second part is the weaknesses. Digi's key weaknesses include a lack of strong position in the postpaid market and lack of understanding of competitor weaknesses. Furthermore, Digi does not have strong position in the postpaid market, and one of its weaknesses is lack of understanding about its major competitors. When compared to its major competitors, which is Maxis, it does not have a strong position in the postpaid market. Furthermore, Digi revenue has been declining, and one of the reasons is the implementation of the U Mobile New strategy, which provide a package with the same rates and benefit for both prepaid and postpaid service. With the implementation of this strategy, U Mobile provide free streaming on websites such as YouTube, Netflix, and others. Next is opportunities. As we know, the amount of smartphone users in Malaysia is rapidly increasing. So the increasing number of smartphone users will result in increase in Digi revenue in terms of prepaid or postpaid revenue due to an increase in subscription. So the forecast may assist Digi in maintaining their revenue and subscription amount. And the last part is the trade. For the trade, if Digi maintains their strategy while ignoring competitor strategy, their market share will fall further. People going to look for plans or package that are both inexpensive and of high quality. For example, U Mobile did offer appealing data plans that included unlimited data and unlimited calls across all networks for only RM50. So because of the rapid advancement of technology, people prefer to communicate with their friends and family through social apps rather than phone call. A new plan offered by Mobile provides a high value quota of data to ensure that their customer use it in a convenient and satisfied manner. So if DG continues to ignore its competitor strategy, customer may switch to its competitors' brands.
My name is Umu Alia Barila. I will explain about the vertical analysis. Vertical analysis is an appropriate analysis of financial statement in which each line item is listed as a percentage of another item. That means that on an income statement, each line item is expressed as a percentage of gross sales, where on a balance sheet, each item is expressed as a percentage of total sales. According to the table in the report, it shows that the profit for the financial year that representing total comprehensive income for the financial year has been decreasing for 3 consecutive years, where in 2019 the profit was 22.75%, while in 2020 the profit was 19.84% and also decreased to 18.34% in 2021.
Alright, from the vertical analysis that we made in the DJ Berhad, we can see that total asset of the company will increase in 2019 to 2020, then decreasing from 2020 to 2021. From the total asset, the total non-current asset of the company are consistently increasing from 2019 to 2021, which we can see in 2019. Non-current asset was 77.21% and then increased to 81.3% in 2020 and then lastly increased to 81.85% in 2021. From the analysis, the total current asset consistently decreased from 2019 to 2021, which in 2019 total current asset of the company were 22.8% and then decreased to 18.70% in 2020 and lastly decreased to 18.15% in 2021. Current asset of the company will decrease probably due to the high income tax level. Tax recoverable increase in 2020 and then income tax recoverable does not exist in 2021. Alright, the last one is on the working capital. So, current asset and current liabilities of DG in 2019 were 22.80% and 33.84% respectively. In 2020, the current asset were 18.70% and the current liability were 30.71%. And lastly, in 2021, it shows that current asset was 18.15% and current liability was 37.40%. From the vertical analysis, we can see that DG's working capital shows the negative figure since the current liability are more than the current asset. Since DG's Berhad is the big firm that public knows, it might be because of they need to rely on the borrowing or stock issuance in order to finance their working capital. This could be due to the COVID-19 outbreak pandemic, which is many of the businesses out there were struggling with the financial issues, so they need to make borrowing in order to finance their working capital.
Assalamualaikum warahmatullahi wabarakatuh. My name is Umu Alia Barila binti Hasan. Now I will present about the first financial ratios analysis, which is a liquidity ratios. Liquidity ratios are type of financial metric that assesses a debtor's ability to repay current debt obligation without raising external capital. This analysis is important for lenders and creditors who want to get a sense of borrowers or customer financial situation before granting them credit. The first one is the current ratio. Current ratio measures a company ability to pay short-term obligation or those due within 1 year, which is it tells investors and analyze how a company can maximize the current asset on its balance sheet to satisfy its current debt and others payment. Next is a quick ratio. Quick ratio is an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligation with its most liquid asset. The next one is cash ratio, which is show a company ability to cover its short-term obligation with cash and cash equivalent. Now we move to the analysis that we have done. The first one is the current ratio. As we can see, at the 2019 current ratio of DG is 0.67 and decreased at 2020 0.61 and decreased again at 2021, which is 0.48. It shows that DG has some problem with the company's finance since the current ratio for the 3 consecutive years are less than 1. DG debt maturing in a year or less is greater than its asset, cash or other short-term assets that are expected to be converted into cash in a year or less. DG having challenges in maintaining its capital due to the pandemic, such as the shifting customer behavior. We move to the quick ratio. As you can see at this table, quick ratio for 2019 is 0.64 and decreased to at 2020, which is 0.55, and decreased again at 2021, 0.45. It means that DG have a weak financial condition, which maybe DG struggle to pay off the debt since the liquid asset not able to cover the short-term debt. DG having problem where most of the customer keep complaining about its connectivity, especially during the pandemic. Due to the net issue, most of customers prefer to change its subscription to other telco companies. Next, we move to the last of the liquidity ratio, which is the cash ratio. As we can see, cash ratio of DG is less than 0.5, which is DG has not much cash and cash equivalent at hand than its short-term debt. It may be due to DG provide prepaid and postpaid payment from the customer, and also the monthly installment from the selling device was in postpaid term.
Hello, Assalamualaikum. My name is Nashufin Asmanti Kamarudin, and I'm going to explain more into a leverage ratio. A leverage ratio is any kind of financial ratio that indicate the level debts that incurred in a business entity against several other accounts in its balance sheet, income statement, and cash flow statement. So this ratio will provide an indication on how company's asset and business operation are financed. It also evaluates company solvency and capital structure. Having high leverage in a firm capital structure can be risky, but it's also
provide benefits. The use of leverage is beneficial during times when the firm is earning profit. On the other hand, a highly leveraged firm will have trouble if it experiences a decline in profitability and may be at a higher risk of default than an unlevered or less leveraged firm in the same situation. Next, debt to asset ratio is a type of leverage ratio that compare company debt's obligation to the total asset of the company. It can reveal information about the company capital structure and provide insight into its leverage. The formula was total debt must be divided with its total asset. The table shows that the debt ratio for the year 2019 was 0.63, while in 2020 was increased to 0.67, and the year 2021 has the highest debt ratio, which was 0.92. The lower is more better. This analysis shows that the business has more asset than debt in 3 consecutive years because the ratio are less than 1. Since Digi.com Berhad is a telecom sector, it is a must to deal with a long-term debt leads with low asset values and available capital that signifies a risky business. Next is debt to equity ratio. Debt to equity ratio is calculated by dividing the company shareholder equity by total debt. It's reflecting the company's overall leverage, thus its capacity to raise more debt. By using the debt to equity ratio, the investor get to know how a firm is doing in capital structure and how solvent the firm is as a whole. Regarding the calculation table in the slide, it is shown that in the year 2019, the debt to equity ratio recorded was the lowest one, which was 7.8 times. In 2020, it was 9.0 times, and the highest was in 2021, which was 11.39 times. The lower the ratio, the better, because a high debt to equity ratio is frequently associated with high risk, or it indicates that a corporation has used debt to fund its expansion. Next ratio is a debt to capital ratio. So for this ratio, it can be measured by taking the company's debt and dividing by its total capital. The debt to capital ratio gives analysts and investors a better idea of a company's financial structure and whether or not the company is suitable for the investment. According to the table, the debt to capital ratio in 2019 was 0.89. The ratio increased to 0.9 in 2020. And the highest debt to capital ratio was 0.92 in 2021. When other factors are considered, it indicates that the debt level are manageable and the firm is less risky to invest in or to lend to. Last ratio in the leverage ratio was the asset to equity ratio. The asset to equity ratio reveals the proportion of an entity's asset that has been funded with its shareholder. Based on the table, it showed that the asset to equity ratio in 2019 was 12.35. Meanwhile, in 2020, the ratio has increased to 13.51. But in the year of 2021, the asset to equity ratio decreased to 12.39, a low ratio that indicates that a business has been financed in a conservative manner with a large proportion of investor funding and a small amount of debt. A low ratio should be a goal when the cash flow are highly variable. Since it is quite difficult to pay off the debt in this situation, a higher
ratio is tolerable when a business has a long history of consistent cash flow, and those cash flow are expected to continue into the future.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Syahidah binti Muhammad Noor. Next, I will be presenting on the profitability ratio that we want to analyze from DG Berhad. We chose a return on asset and return on equity to be analyzed in profitability ratio. Firstly, return on assets can be defined as an indicator how profitable the company is relative to its total asset. Return on assets are calculated by dividing the total company's operating earning by its total asset. Okay, return on assets shows how much a profit of a company makes after taxes for every ringgit invested in asset does the company own. It measures the intensity of assets of the company, which is the highest asset intensity should consider to make a major and significant investment in machinery and equipment. From the financial analysis that we make in DG Berhad, highest rate of return on asset for DG was in the year of 2019, which is shown as 0.18, and the lowest one in 2021 by 0.15. It means that in 2021, DG should consider to making a major and significant investments since the productivity of firms is lowest. Asset intensity shows how effectively the company operated in their business. This is the reasons why DG should consider to making a major and significant investments since their productivity is lowest, which is 0.15 as mentioned before. Right. The second profitability ratio that we analyze is on the return on equity. So, higher rate of return on equity is one of the reasons why investors purchase the company stock. It also shows that the company are less dependent on debt since the company is capable to generate the cash internally. From the financial analysis that we made in DG Berhad, the highest return on equity was in 2019, which is by 2.15, and the lowest one is in 2021, which is 1.80. It shows that DG are better in converting its equity financing into a profit in 2019. The return on equity in DG was decreasing consistently decreasing from 2019 to 2021. The efficiency of DG in managing their equity in the business to generate the income and profit are decreasing in 2019 to 2021.
Hello and Assalamualaikum everyone. My name is Angkuno Arisha Nadira, and I will continue the presentation with the next part, which is non-financial performance of DG. Even amid difficult circumstances, DG honored its pledge to keep consumers connected to what is most important. As the reality of the worldwide epidemic set in Malaysia, this pledge took on a new significance. DG took on a vital role of guaranteeing that people could study and work from anywhere, that they could simply migrate to online transaction for personal and business purposes, and that they could socially link it with one another even when we were physically separated. Firstly, is creating value for its shareholder amidst pandemic. DG continued to enhance network availability and quality, allowing consumers to stay connected while reaping the full advantages of digital technology. Initiatives undertaken at the outbreak inception in 2020 were prolonged into 2021. Because of the accessibility of this digital solution, consumers and businesses have been able to reduce their carbon footprint, aiding DG in promoting greater climate action across its value chain. Next is sustaining its return to shareholders. DG's emphasis on strategic goals and solid financial management have driven the board to announce a net dividend per share of 14.9 cents, returning 1,158 million to shareholders and sustaining a near 100% dividend payout ratio for the year of 2021. Each year, the firm outperforms its dividend policy of sharing at least 80% of net profits, indicating its commitment to providing shareholders with substantial and sustained returns. Next is strengthening its diversity commitment. Digi's people strategy places great value on diversity and inclusion. To best represent its wide variety of customers, the firm believes that a diverse workforce at all levels of the organization with a number of viewpoints is an advantage. With its second-year inclusion in the worldwide Bloomberg Gender Equality Index 2022, the board is happy that Digi is recognized as a leader in this regard. Digi has ratified the UN Women's Empowerment Principles and joined the 30% Club, indicating its dedication to diversity and inclusion initiatives. Lastly, is delivering its responsible business commitment. Responsible business is a key component of Digi's strategy, ingrained on how the firm operates and the expectation it has of its supply chain. The company's responsible business framework is based on Yellow Heart brand aspiration, which is to improve standard across its operation and supply chain and to collaborate effectively to create capabilities and resilience for an advanced digital future. Digi's MSCI Environmental, Social and Governance score was raised from A to AA in 2021, keeping it on track to become one of Malaysia's top-performing corporations in terms of sustainable business practices and ESG policies. Now we'll move to the short-term future prospect of Digi. Accelerated digitization will continue to drive demand for connectivity and digital infrastructure, and the telecommunications sector will expand quickly with substantial new prospects afforded by 5G, artificial intelligence, and the Internet of Things. The mobile telecom sector is anxiously awaiting for the Malaysian government policy decision on the 5G rollout. Digis continue to support the My Digital program and believes that 5G networks are essential infrastructure for the progress of Malaysia's digital economy. Looking ahead, Digi hopes to add even more value to the company. The planned merger with Celcom Axiata Berhad seeks to establish Malaysia's top telecommunications service provider. The new business will be able to deliver better network quality and coverage, as well as have more scale to invest in, develop new digital solutions, catalyze new growth prospects for major corporations and SMEs, and attract and collaborate with global digital giants. It will also use economies of scale to boost operational efficiency while strengthening core distribution and offering better network operations. Based on the analysis presented, we can assume that Digi's corporate performance is falling as a result of the COVID-19 epidemic, which has affected people all around the world. To boost the company's success in the future, Digi must undertake a few urgent initiatives to get back on track and maintain a positive reputation. The managing directors of Digi must be prepared with a variety of business plans and strategies in order to withstand the current uncertain economic climate. Furthermore, finance managers must be more vigilant in monitoring their liabilities. To increase cash stability, Digi may negotiate with the bank to modify terms of its loan by extending the repayment schedule. Digi will have sufficient funds to settle its loan if it has more time. Overall, we anticipate Digi to implement its recovery strategy in 2022 to address the after effects of COVID-19 on the company. According to several sources, Digi and Celcom Axiata Berhad are planning a merger to become Malaysia's largest telecommunications service provider. We are certain that Digi will continue to strengthen its consumer convenience offerings in the future.